Welcome everyone to the town hall. It's a great Friday and we have a great VIP guest and we'll have some news as well. First, let's take a look at who we've got as our guest today, in case you don't already know Alan Bourne. He's the Director of Technology Investment Banking for Fairmount Partners. He hails out of Philadelphia. Don't hold that against him. So do I, just as a reminder. But it's, I think our first meeting, actually, Alan, was out in Vegas, right? So you never know where your neighbors are going to turn up and have a chance to meet.
We had to go all the way there to meet.
That's right. In the collaboration zone. So last week there was a piece of news that we received in our email, which was shared through the town crier feed that hopefully all of you get. And in that was a report that Alan and his team build quarterly, amazingly, on HR tech market. And that seems to be the common theme here, HR tech and AI somewhere. I'm sure it's buried in there. So we'll be looking at the details of the report. And Alan, if you're able to share your screen with that report, should you be leveraging the visuals from that? If not, I can do it. Just let me know.
No, I can. I'm happy to share my screen.
Okay, perfect. And anyway, in the release itself, there's a link to get the report. And I think, Alan, you're going to share a link to be placed on their distribution list. So make sure
we use Constant Contact. So I'm going to try this.
Okay.
That should. I looked at that URL. I'm like, you got to be kidding me. But that's it.
In the chat.
I just put it in the chat.
All right, perfect. And great. So that's the top news we're going to cover. And with that, Alan, I'll let you dive in and introduce yourself, and we'll certainly dive into the report. And anybody can ask questions throughout. We are recording this for Alan's purpose, and if he loves it so much, we'll probably post it on our YouTube channel for HR Tech Alliances, so the world at large can get to know what Fairmount Partners is up to, and Alan as well as the great info they're sharing.
Thank you. I appreciate it. So we'll go ahead and I'll share my screen. And let's see if this works. All right. Can you guys see that okay?
And yes.
All right. Perfect. Awesome. So just a couple of quick, a little bit about us, not to be a long commercial, but a little bit of a commercial. So Fairmount Partners, we're investment bankers. We're based out of the Philadelphia area. There's about 20 of us. We focus on 4 major industry segments, technology being one of them, obviously. We also focus on healthcare services, consumer and industrial, and business and consulting services, which interestingly enough is a lot of staffing companies. Within the technology sector, we focus horizontally on understanding SaaS companies, really understanding SaaS companies and data analytics companies. And we work really hard to try and understand what drives value in emerging growth technology companies. And, by analyzing the deals that happen, what are the levers that you can pull to maximize value, right? What's the right combination of growth rate, net revenue retention, gross margins, profitability, right? Unit economics that companies can pull in order to optimize value. And then what we do is we work with our clients to help them make sure that they're pulling the right levers, that we're positioning things the right way, and then trying to run a good process in a sell side M&A. We typically get involved with companies at an earlier stage than we represent them on the sell side. So if someone calls me up and they're a $10 million ARR business and say, Alan, I want you to take us to market today, happy to do it. Love to do it. But more often we get involved in companies that are a little bit earlier, that are on a growth trajectory, and by leveraging what we're really good at, which is helping companies think about the right way to position themselves, helping companies think about what their TAM is, what their moat is, what does their model look like, right? And providing guidance along the way. We develop relationships with companies that are emerging growth companies, add some value, and then down the road, we get involved in a sales transaction. About 70% of what we do is sell-side M&A. About 20% of what we do is buy-side M&A, and then the rest is later stage growth equity. So the bottom left corner shows what we focus on the tech side. So now we're really good at emerging growth. We apply these our capabilities to specific industries, HR tech being one of them. And one of the reasons that I am really excited about HR tech and have been for a while is because, first of all, I live the problem, right? We've got 25 people, and we've got, a bunch of junior people. And, when COVID hit, we were dead for like a couple of months, and then everything took off. And so we were grinding our employees, and they weren't able to come to the office. They were sitting at home. Some of them were new to Philadelphia. A lot of them were new to Philadelphia, and they had no one to talk to but their cat, right? And we're still grinding them the way that we always grind. And so at bonus period at the end of COVID, so January 2021, we had just had a killer year. And we had 7 analysts. We lost 5 of them after bonuses were paid out. And so, I think that's a problem that a lot of people experience, right? How do you retain your employees? How do you grow your employees? How do you teach your employees, right? And that's one of the things that's really cool about HR technology is, again, this is a lived problem for me. The other thing I think that's really interesting about HR tech is that you find so many interesting companies that serve interesting niches that are bootstrapped, that know how to run businesses because they haven't taken a lot of money, and I think you've got just in general better operators than a lot of the technology space. Like if you go to an IoT conference, you can't find anybody who's not raised $10 million in venture. So it's a good sector, and it sets up well for us. So this is our team. We divide HR tech into 3 different segments, like probably a lot of people do. So talent acquisition, talent management, and HCM, which includes core. And there's always the question at every quarter. It's like, do we just want to call it core, or do we call it HCM? But it's sort of core. And then we follow a bunch of companies and just try and stay smart in the space, and provide this document quarterly to really anybody who wants it, unless you're competition, in which case I'm not going to give it to you. So just to give you a sense for the market, we track M&A, we track public markets. So the highlights here are large cap. So we don't, when we think about the public markets, because a lot of HR tech companies do a lot of different things, they don't necessarily line up neatly in talent acquisition or talent management or core. Well, some of them do, right? The core guys do, the payroll guys. But so instead of trying to group them within a particular space, we really focus on them large cap, small cap. And I think our small cap is like below 600 million in enterprise value. And you can see that there's a real big difference between valuation for the big guys and valuation for the little guys, right? And so, that's one of the things that I think we note. The large companies are trading for 8x median revenue. And then the mid-cap groups are trading for about 2.3 times. No IPOs in the last year. Now we know that there are a couple that are sort of waiting in the wings, Gusto, Deal potentially, the unicorns out there that have been doing well. But the IPO window for technology as a whole has been closed. And then in terms of where M&A markets are, median for HR tech is about 3.7 times LTM, 3.7 times LTM revenue, 119 deals over the last year, a fewer number of deals over 5x. There were three deals over 5x over the last year, and I think that is indicative of really what has been happening in the technology M&A market, which is it's been really slow. Technology has been really slow, and it began sort of in mid 2022 and has really continued through, I would say, the first half of 2023. And a lot of what has been driving that is, when you go back to mid 2021, SaaS companies were trading at 20 times revenue, right? And in 2022 was just a straight line down to about 5 for SaaS companies, right? So SaaS companies lost 2/3 of their value in 2022. And so technology companies are looking at what's going on in the M&A, what's going on from a multiple perspective, and are waiting on the sidelines. In addition, so not only are they waiting on the sidelines because the M&A markets, that the valuations are coming down, also there was a lot of uncertainty around what does the economic environment look like for software and for technology in general. And I think over the last 6 months or so, the last 4 months, people are starting to get more comfortable. There was good news in the journal yesterday that we may be looking at a soft landing, and so I think we're starting to see a more active M&A environment. Brazen just sold to Radency, so I think things are hopefully starting to pick up. And so the market update is, capital activity slowed. I don't think there's any surprise about that. And then I think we also make the point here that everyone is offering generative AI. And I think they're trying to figure out ways to leverage it in talent acquisition, trying to figure out ways to leverage it in talent management. And so everybody's working on a generative AI solution. So in terms of and by the way, if anybody has a question, feel free to stop me, and I think we'll also have time for questions at the end. But in terms of the trends that we're seeing and watching that are affecting HR tech companies, number one, again, is AI. And when you think about it, about how pervasive it is today, ChatGPT only got launched for real a year ago, yeah. Right? And so so now everybody's got a generative offer. Bard has been rolled out. We actually know the guy who runs AI for Google, but it is certainly become much more interesting. The market is adopting it rapidly, and I think really it goes beyond the generative side, and it's really about large language models and analyzing massive amounts of data. The predictive capability of AI is going to be really exciting beyond just having access to data at your fingertips. Predicting employee retention, predicting which employees are going to succeed based on tons of data and tons of resumes and things like that. So I think that's a big trend. Economic pressure is obviously on everybody's mind. That's a big trend. Priorities have shifted. So, I think in today's environment, it should be no surprise that retention or that talent acquisition, talent retention are getting less focus. Engagement, DEI, getting less focus. It's really all around the needs to have versus the nice to have. And so where you're seeing that play out is things like payroll, right? Core HR, and when you go back and look at where the investment is being made, a lot of it's being made in core HR. And it's funny, you sort of think about, well, geez, how many payroll companies do you need? But there's payroll companies that are out there that are doing really interesting things and serving really interesting niches. Like we ran across a company called Career Plug, which is based in Austin, and they're doing double-digit ARR, and their unique niche is franchises, right? And so, so I think being able to provide a core function that's a need to have is where people are is where people are spending a lot of time. Back to office is still, it sort of swings both ways, and we still haven't, and enterprise hasn't figured it out yet. So there was a big backlash against return to office, and everybody's saying you gotta come back in. We at Fairmount Partners, I think we do 2 days a week, and it seems to work pretty well. We got small teams, so it's hard to hide, and like it might be in a big organization, but there's definitely a backlash against it. But there's data that just came out that I think public companies perform 16% better if they've got flexible work schedules than they do if they've got rigid work schedules. Something like that. I heard it on the radio this morning. And so I think people just continue to try and find their way and find the right balance for back to work, and no one's got it completely figured out yet. And I think technologies that help companies figure it out, there's going to be interest in that. Skills-based hiring is something that I think a lot of people talk about. I think it's we're starting to see it more. It represents a pretty significant change in culture and process from the way enterprise hires, right? And so I think it's been a little bit slow to adopt, but I think we're starting to see more people recognize, particularly in the technology side, right? If you've got the right skills, and in a tight labor market, especially if you've got the right skills, then it creates more retention. It does add diversity to your talent pool, and so I think we're starting to see people embrace it more, although it's a little bit slow. Tech layoffs, they represent an opportunity for HR tech vendors, unless you're looking for AI engineers or AI programmers, in which case what we experienced a year and a half ago or 2 years ago, where Google and Microsoft and those guys were hiring all the tech talent at massive packages. We're seeing that again, but specifically for AI engineers, as you go back to the top point, which is AI is really hot, and people are trying to carve out their space. And so I'll sort of blow through this. Here's what we do. We do have a market map. We try and keep this current of the folks that participate in the various spaces. We try and provide current data on what's happening within each of those spaces. These are the shows that we attend. So next one I'll be at Transform in Vegas. That's a fun show with a great party at the end. SIA Executive Forum, SHRM Talent, Unleash. I don't know if I'll go to Unleash this year. I went last year. The SHRM show is good, and then HR Tech again in the fall. And there's a learning and development one in April that I might go to as well. But here's where we typically go.
All in Las Vegas.
Yeah, that's right. They're all in Las Vegas. I spend too much time in Vegas.
Oh, the learning and HR Tech shows in Orlando, at least. So
yeah, that's right. And I think you might have been the one that mentioned that to me.
Yeah, we'll have a collaboration zone there. It's going to be awesome. So be sure to check it out.
There's a lot of people that will not travel the 5 hours from Florida to Vegas. So it's good to occasionally come back to Orlando.
Yeah, for sure. So just some, I talked a lot about this in terms of the market conditions. I mean, we keep an eye on inflation we keep an eye on hiring, and the reason that we keep an eye on inflation and hiring is because it has a direct impact on what the Fed does, and then consequently a direct impact on the debt markets and on the equity markets. And there's been news since, well, really, I think last week. I think inflation is continuing to come down. The Fed's target is 2%. We're at about 3%. I think the October number was at about 3% as well, right? And paying attention to that 3% is important, again, because the Fed's target is 2%. As we inch towards the 2%, that signals that they're gonna, they'll pause with the rate hikes. I think the market thinks now that, given the fact that, so we came in with a weaker hiring number. I think the hiring number in October was around 209. Like, so September a tick up. The hiring number for October was down, so that's good. People are now, so the futures market actually places bets on, are we going to be in a rate hike environment or a rate decline environment? The futures markets are building in a 65% chance of rate reductions beginning next year. And it's looking increasingly like, and again, this was an article in the Wall Street Journal yesterday, that we're looking at a soft landing as opposed to tipping into a major recession. Now, we still feel the pain of the economy tightening a little bit with layoffs and things like that. I think Beamery just is experiencing some layoffs. Some of the bigger companies are experiencing layoffs as well. So we're still seeing that. And if you're on the end of that, it really sucks. But the economy as a whole appears to be resilient. And we think that this will translate into a positive M&A environment going into 2024. Here you get a sense for where multiples have been. So on the large cap side, on the large cap side, you've got the multiples and then total enterprise values on the right side. But if you go back, I mean, so we're not where we were in 2021 at 8.2 or 9.2, but we're at 8. And we're certainly off the lows of early 2022. So the large cap group is doing well. The small cap group or the mid cap group, they're lower. They're sort of on the lower end of where they have been, but they haven't moved a ton, right? So we're looking at sort of 2.3 times for the mid cap versus 2.9 back in March of 2020. And then here's a sense for, the 1 year and 3 year stock performance. You can see what happened to the mid cap HR Tech. It just blew up in 2021 and has come down. Our SaaS index is the orange one that blew up and has really struggled in the last year or so. I don't need to go through all the comps. We also track who the big acquirers are, because it's good. We try and have good relationships with these folks so that we can, it's helpful to understand who are the acquirers in the space, what are their areas of focus, what are they looking for, so that when we work with our clients, we can provide good feedback. And then here's a sense for M&A transactions. This is a little bit hard to read, but we track, and I think last 12 months is probably most relevant. We track sort of average value multiples, but then we also track it by size, right? And you see that, as you get bigger, there's typically a premium for size on M&A. And then here are some of, I think the point here is there are premiums that are still being had out there. Like Reward Gateway was a 12 times revenue deal. Intella HR, and again, these are 2023, right? That was about an 11 times deal. K1 did a deal. They're the ones that rolled up Employ. at 6 times revenue. So decent valuations are still being out there. And the way that I would characterize the market is it's a little bit bifurcated. So you've got and this is the way a private equity guy explained it to me. He said, you got a lot of people trading in the seven times or greater. And then they're seeing a lot in the 4 times or lower, not a lot in the middle. And so what that means is that these really good companies that have strong net revenue retention, that have strong growth, that have scale, there aren't that many out there in the market. And so people are chasing them. And so despite the fact that, you look at multiples, SaaS multiples are down, HR tech, you look at that and you say, yeah, on aggregate they are. But if you're an A player, you're still getting really good valuations out there in the market. If you're a C player, it's harder. And then if you're a B player, those folks are still waiting it out. Although I think we're starting to see a little bit more activity with them as well. And so that's kind of the update. I am happy to pause there and answer any questions that any folks have.
Hey, Alan, real quick on the looking at these sheets, what do you think the NRR were for some of these like Medallia and stuff? Do you know much of that yet?
I don't. That's a really good question. I do not know the NRR there. I mean, I can tell you that what we're seeing for enterprise, enterprise is harder. Anything that's sort of in the 100, so above 100 is good. Above 110% or above 110% is outstanding for enterprise. I mean, we're seeing some in the emerging growth stage that are like 130% net revenue retention. And those, even in an environment with headwinds, if they've got good growth beyond that, everybody wants to do those deals.
All right, thanks.
Mm-hmm. Any other questions for me?
How about the intangibles? I mean, there's no doubt that everything comes back to show me the numbers, but
yeah,
when you look at a technology and you just feel like this is going to be the next home run, how do you incorporate that into your analysis?
Yeah, that's a great question. So the way we've got a framework that we call P5M, and it may be in this report or it may not be. But when we're looking at companies, we sort of measure them on 5 different vectors. Positioning is one. How unique is your product, right? So that's the P. The M's are market. Do you have a big TAM? Moat. Do you have a big moat around your product? Management, solid bench. Momentum. That goes into NRR, growth rate, and then model, right? So we're measuring companies on these various vectors. We try and do it early so that we can say, okay, you need to work on this or you need to work on that. You're really good here. So to your question, the unique value proposition that a customer may have, we seek to understand that, right? And we seek to understand that in the context of what are buyers looking for? Where are their gaps, right? And Workday is a really good example of a group that partners through partnerships and channel strategy and alliances. And then for those companies that really feel a critical need, like a Pecan, for instance, they'll pay big money for them. And so, so how does it factor in? Well, if you've got a really unique value proposition and a very strong moat around what you do, right? If you have strong proof points and strong momentum that demonstrate that, there's market uptake, product market fit, right? Those get valued at premiums because you're a growing business in a unique market that you own. It may be a small TAM today growing to a big TAM, but you've got a leadership position there. That you can't put a multiple on it, but you can certainly, what buyers do. So this is actually interesting. And buyers will negotiate based on market multiples, but they will value based on model. Meaning that a buyer will so when they come up with the valuation that they're going to offer a company that they want to buy, they're gonna value based on median. So we HR tech companies trade for 3.5 times revenue. But internally, what they're doing is they're saying, all right, what can we do with this asset? How can we grow it? How can we leverage it? How can we scale it? And they're building an IRR model. And so what we do in our approach is we understand how they're approaching valuation. We understand that they're going to negotiate based on M&A, but they're going to value it based on what does this really mean to us? And we try and understand that. We try and understand that dynamic. And when someone says to us, well, this is where industry comps are, we say, well, you're looking at it the wrong way. What does this do to you? And we don't want all of that IRR, but we want some of it. And so, Larry, to your question, it factors in a very big way. But again, you can't put a multiple on it, but you can certainly use it to drive a higher than industry multiple by trying to help them understand the economic value that you're bringing to their business, if that makes sense. Cool.
Hey, Alan, you had mentioned IRR. What's that? Is that income revenue retention?
It's internal. It's an internal rate of return.
Oh, got it. All right.
Yeah.
My non-finance founder here.
Yeah, no, that's okay. I mean, basically, what's the return on? I pay $20 million for this. What's the value that I'm going to get over the course of 3 years? Right. That's the calculus that they're doing, and so they're trying to model in a really strong IRR so that they can go to their investment committee or their board or whoever and say, look, our IRR is going to be X, or we think our cash on cash return is going to be 5X, right? So that's how they approach it, but that's not how they negotiate it, if that makes sense.
Yep. But on the other side, that's how I should negotiate it.
Yeah, exactly.
If I was going to sell.
Yeah, that's right. Other
Alan,
questions for me?
There was a question in the chat. I got, well, it was sent to me directly, but basically said, hey, we're a small bootstrapped, SaaS HR tech company with a focus on skills-based hiring. How can we get attention? What should we be doing now, I guess, to collaborate with your group, for example, or prepare for that?
Yeah. No, I'm happy to answer that question. So we are always interested in meeting interesting companies and learning about what they do. So the way that you get involved with me today is just send me an email and say, hey, I'd love to chat about what we do. Now, in terms of getting noticed by strategics, one of the things that we will do is, and really this comes down to partnering. The best way to get noticed by a strategic is to have an alliance with them or have a partnership with them, right? And we sort of think about this as a Trojan horse strategy, right? You go in there, you partner with them, you show a lot of value, you show how they can leverage your platform, right? Even a small group, right? But you show what you can do on their platform, and build a relationship. They come to value your product and respect your product set. And then when you're ready to get liquidity, you can go to them and say, hey, I got good news and bad news. The good news is that I got an acquisition, somebody's interested in buying me. The bad news is that you might not like who we end up with. So should we talk M&A? And a lot of times they'll come to you even before that happens, right? They'll say, we ought to buy you. So the word with the alliance approach and the partnership approach is really, really valuable. Again, Pecan was a partner of Workday before they got acquired. They showed that they had a lot of value there.
Does that relate? I mean, I saw your chart said like what, 22 times revenue or something?
Yeah, there's an argument about whether it's 22 or 12, but it's still a lot.
Still 12 is a lot. Yeah. I
Yeah,
mean,
and also you gotta remember that was like peak COVID market craziness in 2021.
Okay. Well, I mean, that sounds like a good strategy. And, we generically call it, getting dating before you get married, right?
That's right.
And maybe have multiple dates with multiple suitors, right? Because and that's where you come in, right? That's what you do.
Right.
You help shop it and get attention and hopefully a bidding war, right?
That's right.
Hopefully
that's what we hope for. I mean, there was a company that we sold, and this is a really good example of the type of work we do. And it's not meant to be a commercial, but it's sort of indicative of how we think about things. So there's a company that we sold a couple years ago, and again, we sold at peak COVID. But we had been working with them for 2 years. They came to us. They were doing about 10 million in revenue. They were doing about $1 million in EBITDA. But as we did our analysis on them, we're like, look, your TAM is too small. Your product set is too narrow. You lack some key management people. You got to work on these things, because they wanted $40 million. We said, I don't know that you can get $40 million, right? Unless you address these things. And they addressed them. And 2 years later, they were doing $20 million in revenue, ARR, and they were doing, call it $4 or $5 million in EBITDA, and had addressed everything that we suggested that they address. Had really strong growth, and we took them to market. We thought we'd get $125 million for them, but we found two groups that absolutely had to have the product, and a bidding war ensued, and we sold that business for $310 million. And again, it was, part of it's the market, right? You don't always get that lucky, but that's the goal, is to have a situation where you've got multiple people who really need your product. And one of the things that a good banker will do, me or whoever you use, is not just say, okay, here's the positioning of the product to the market, or here's the positioning of the company to the market. You really got to understand what SAP is looking for, and what Cornerstone's looking for, and what Workday's looking for. And by understanding what they're looking for, you got to position your messaging specifically to address their needs, right? It doesn't mean that you got to write a separate book for everybody, or even a separate teaser for everybody. But when you pick up the phone and call Corp Dev at Workday, you need to understand what their pain points are and what their M&A strategy is, and explain to them quickly how this company fits into their M&A strategy.
Yeah, no, that's fantastic. And then that kind of addresses the last question. See, posted up about, what if the investor's like, well, it's a crowded market, and they're trying to push back. I mean, what you just said was, there's a niche. And if you can find that, particularly with the buyers, and some of it is, there's a window of opportunity, but you got to always look for that niche. And you
got to look for the niche. Yeah, that's exactly right. I mean, there's 1 million ATSs out there, right? And Career Plug is an ATS, but it's an ATS with a specific vertical that they go after, and a specific area of expertise. And if you can demonstrate a really strong position in the market, and a really strong focus area where you're really, really good at, no one else can beat you. Yes, ATSs are a crowded market, but not ATSs that focus on franchises.
Right. So look for that niche. It'll also help with your partner strategy. It'll get you more dates with the big shops. And then when you come in, it'll just be easy.
Yep.
Not really, but yeah.
Yeah. And then I see a question from Iona, and hopefully I pronounced your name correctly. What have you noticed in particular about pre-seed HR tech startups, investors that aren't experts in the space? Right. I think the key there is, you want somebody who understands your space, right? And there's plenty of VCs out there who understand HR technology. and who will speak your language. And so part of it is being focused in terms of, hey, let me tell you what the problem is that I'm solving and how I'm solving it, right? Uniquely that no one else is doing, right? If they understand that, then they'll get it.
Great. Yeah. And there's plenty out there. You just got to find the right ones. And that's probably a big part of what you do, the value you do as an investment banker, right? Is to help discover the right investors to get to that next level and to the exit, not just any old investor that,
Yeah, that's right. I mean, everybody's money is the same color. You really, when you think about, and look, sometimes you don't have a choice. Somebody's willing to put money in your business and you need money, you take it. But all things being equal, if you can find somebody who understands your business, can add value in terms of connections, board members, strategy, right? I would argue that you should be willing to take a lower valuation from someone who can help advance your business in a meaningful way, than a higher valuation from somebody who just doesn't understand your industry all that well.
Thank you. Thanks for your feedback.
I think there were some other questions in the chat that I didn't get to. Maybe Vivek, did you get yours answered?
Yeah, let me pose my question.
Okay.
So, Alan, you talked a lot about the 2020 crazy valuations and
Yes.
and the subsequent corrections we saw last year. Going forward, what does a healthy recovery look like to you? And by healthy, I really mean in the truest sense of the word, healthy, being sustainable, something that is fair market value, that sort of thing. So what does that picture look like?
Yeah. Let me share a screen here. So this is sort of.
And while he's bringing that up,
Yeah.
for some of the new folks on the call, after we wrap up this segment, we'll have a few minutes. If you want to introduce yourself, keep it to like 30-second elevator pitch would be amazing.
Right.
We'll pass the mic around after.
All right. So this is probably the better one. Here's how we think about valuation. Right. And this goes back to, so if you look at the 3 years stock index performance, right, think of this as a proxy for multiples. If you draw a straight line back, right, and so we'll use the large cap, or actually we'll use the NASDAQ, right? If you draw a straight line back from where we are today to where we were in September 2020, consistent. And when you do that with SaaS multiples, you get the same thing, right? So, historically, again, going back, and what I really need to do is probably do an M&A chart that shows what were median M&A multiples by year. I think that'd probably be meaningful. But when you go back, you see that you've got this bump here in 2021, but we're not that far off from where we were pre-COVID. And here, we're not that far off from where we were pre-COVID. And we see it in technology multiples and across the board, that when you draw a straight line back to like 2019, we're kind of where we were. So I don't anticipate any additional valuation. I don't anticipate much more valuation compression. So I think that sort of where we are is a rational place. What do I think is going to be happening with multiples? I think you'll see that sort of a good 3 to 5 is a ARR is a reasonable multiple for a decent company that's growing at a decent rate. 5 maybe, and that may be median, so call it 4 or 5 maybe median. I think outstanding companies are still going to trade for 7 to 10 times ARR. I don't think we go back to 20 times ARR anytime soon.
That helps. Thank you.
Mm-hmm.
All right. I saw some other questions just about, like Christoph asked here, job boards are creating applicant tracking and basically that kind of, what's it called? Initially go deep, but then now go wide. A lot of the existing companies are doing that, adding more modules. How does that, what's the question? Who will win the game, I guess?
Yeah.
The question is, there's a movement from job boards that also LinkedIn or Indeed, or they all go to more technology. They offer their own ATSs, and there is the ATS market, and
Great.
they somehow go to job boards because they combine a lot of jobs on their side and could also go for candidate attraction. And the question is, who will win the game?
Who the group that will win the game is going to be the group that is able to provide the highest quality candidates at the highest conversion rate. And I think that's the answer, right? And so maybe there's an AI component to that. Maybe there's a social component to that. But it's hard for me to say, you know, is it the ATSs or is it LinkedIn for jobs or is it Google or Twitter for jobs, right? Because a lot of those, I mean, Twitter's new job board is just like job search, right? That, you know, we've been doing for 20 years. But whoever figures out a way to provide better candidates with higher conversion rates to their customers is the winner. And I don't have a crystal ball as to who that's going to be.
We will
Sadly.
see. We will see.
That's right. Maybe it's going to be Stepstone.
Yeah, in some markets, it's so. Yeah, definitely.
Well, that's it. Exactly. It's like the market, the niche, you know, find your niche, go as deep as you can, and then find partners to go wider, right?
Recruitment is always local. So
right.
You can do a really great job in a region, and in another region, you don't get any money.
That's right. That's exactly right. You're right.
Well, we've got a few minutes left, and happy to share some of the news, but I did want to give the mic a minute, if you don't mind, Alan, and please stay on. We come back to questions, but we have a few first-time visitors here. If you don't mind doing a 30-second intro. Let me see. We'll start with Ioana.
Yes, perfect. You said my name great. Ioana, co-founder and CEO of Dextago. It's an AI coaching platform for reducing top talent attrition by 50% in a quarter. How we do that is via personalized, bite-sized, on-demand soft skills development. Thank you very much, and thank you for the awesome presentation. Very insightful.
Thank you.
Any burning questions that got put in the chat that didn't get answered for Alan, or if anybody has a quick brag or announcement or ask of the group, we're happy to give you the floor with a few minutes left.
I'll just jump in with a question. Hi, Alan. Thank you so much for such an insightful session. I'm the founder of Culture Mindful. We're basically building a digital platform designed and backed by neuroscience to help companies help their workforces co-create an inclusive culture of work that's constructive for performance and psychological well-being. I'm curious to know, from what you're seeing in the space, Peakon was one of the largest acquisitions. It said that they were looking to get real-time employee engagement data. Was there anything else of value there that your eyes specifically picked up in terms of looking at that deal?
No, that's a good question. No, I think so. I think they were looking to get real-time employee engagement data. I think the feeling was that the approach that Peakon took was innovative and interesting. And so that's one of the reasons why they liked it. I think they also felt like it integrated well with their solution.
Mm-hmm.
And so a good integration tie, but it's really, they identified that as an area of growth, as a growth area. They felt like they could leverage the heck out of it. And so we're willing to pay an aggressive price.
And just a reminder, in the town hall event, you can connect right here to Alan and all his glorious details. But great way to connect and collaborate, and certainly the other attendees. Easy to find them here right on the attendees tab as well. And a few folks that planned to come weren't able to come, but hopefully we'll see them next week. Well, thank you very much, Alan. It was terrific.
Yep, my pleasure.
Really rich with information and knowledge sharing. We appreciate you doing that for the industry and being so giving to those that aren't clients yet, but I hope they become clients for you, and you'll be able to share in their mutual success as you find them a new home in the future. So Thank you for all you do.
Thank you.
Thank you, Alan. It was great.
Thank